QuickBooks Pro Plus Desktop 2022 OneNote presentation, sales receipt and deposit. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, icon left-hand side, topic introductions, 8120 sales receipt and deposit tab. Also take a look at the immersive reader tool, topic introductions in the text area too. Same name, same number, but with transcripts. Transcripts that can be translated into multiple languages, either listened to or read in them. Same name and number as presentations as well. Topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give accounting background to complement the presentations, and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we're looking at the home page to start off with. We're going to be looking at the sales receipt, which is different from the invoice for the sales item. You could think about the sales receipt happening at a cash register, for example. Someone coming up, for example, in our case with a guitar, purchasing at the same point in time that they get the inventory and that we're going to get paid at that point in time. And then we're going to take those sales receipts, which may include cash, and record the deposit, grouping the deposits in the same format as we expect them to be on the bank side of things, on the bank statement, making the bank reconciliation an easy process. The accounts that will typically be affected, undeposited funds usually going up unless we record it directly into the checking account. And then the rest of the accounts would be similar to an invoice. The other side going to sales. If we're selling inventory and subject to sales tax would be going up. We would also then have the inventory going down, cost of goods sold then going up down below. Here is the sales receipt. We're going to say Garcia Guitars. It's going to go to undeposited funds, noting that undeposited funds is the default. You wouldn't see this option here at all unless you change the settings, go into the edit drop down, and then go into preferences, and then the payments settings, and turn this on so you have the default so that you could deposit it directly in the checking account if you so choose. It would be, here's the actual settings for the preferences. It would be down here in the payments, I believe, if you wanted to make that change. So here's the rest of the sales receipt. We have the two items, an Epiphone Standard Pro, Epiphone Les Paul that we're imagining that were purchased by Garcia Guitar in our actual store. So we're making the transaction and receiving the payment at the same point in time. So then what's going to be the impact on the financial statements? Undeposited funds going up by the $2,310. And then the other side going to sales, but not including the 110. It's only going to be the 1,200 and the 1,000 for the 2,200 going up in sales. The difference being the sales tax of the 110 going to the payable, sales tax payable. There's also going to be a decrease in the inventory account, which is driven by the items. The other side going to cost of goods sold. The amount not being shown here on the sales receipt, but known by the system because we're tracking inventory by the items here. There will also be an impact on the subledger for inventory, tracking the information not just by the dollar amount, but also by the inventory units. So here's the trial balance again. Undeposited funds would have going up. The other side then going to the sales, which would be down below. And then we've got the sales tax payable, which is affected. And then the inventory is going down. And then the cost of goods sold is affected. These cost of goods sold here and the sales here down below. If we look at the inventory subledger would be affected because we sold an inventory item, which is going to be broken out by unit and by the amount. This amount 7938 should tie out to what's on the balance sheet in inventory. Now we're making another sales receipt, this one for Anderson Guitars, and this one's going to be a ukulele, a Epiphone Riviera, and a Gibson USA. Quantities here, what's this going to do? It's going to be increasing the undeposited funds by the total $2,198.70 because we actually received the payment at the point in time we made the sale. The revenue is going to go up, but not including the sales tax, just these three items up top. Then the sales tax is going to go up. That's a payable by the $104.70. We also have a decrease in the inventory by an amount that's not on the sales receipt, but the system knows it through the items, and the cost of goods sold will be affected, and the subledger for accounts receivable tracking the information by units will also be affected. So here's our trial balance. On the trial balance, we had the undeposited funds, which would be, we're in the liability section. Undeposited funds would be going down. The other side's going to sales. which would be here, sales tax payable, which would be here, and then inventory going down, which you can't see, which would be up above, and then the cost of goods sold are the accounts that would be affected. And so here's the sales items. Here's the inventory subledger, which would have been affected as well, giving us the units as well as the cost. And this cost amount should tie out to what is on the balance sheet as we're tracking it in a perpetual inventory system. Now you can see that we have these two items that are ready for deposit. The little 2 represents the fact that those items are in undeposited funds. We could then group them together. If I click on it, here are those 2 items. I can check them both off if we're assuming that we're going to deposit them at the same time, and they're going to show up in the bank statement as one lump sum of, in this case, $4,508.70. If I record it this way, then in our checking account, we're going to see this detail, $4,508.70, which we hope will match the bank statement, making the reconciliation easier. And in undeposited funds, these 2 amounts are going to come out in undeposited funds individually, so we can see the detail. So here we got the checking account would then be going up by the deposit, undeposited funds back down to 0. And so if I scroll down, if we do the same kind of process with journal entries, we're kind of mirror the thing, but now look at journal entries. Here's the journal entry related to the sales receipt where we get paid at the same point in time. It looks similar to one for an invoice, except instead of having accounts receivable, we're debiting the undeposited funds. What do we put in there? The amount of the sales price, $2,200. The payable, we said for the sales tax was 5%, so that's going to be 110 of, or 2,200 times 5%, 110. That means that we're going to get 2,310, which is going to go into undeposited funds. Sales tax payable is going to go up, and then the sales is going to go up. And then the cost of goods sold is going to go up. That's an expense account, and inventory is going to go down. These 2 amounts are given to us, and they wouldn't be on the sales receipt, but it would be tracked by the system. It would be known, in essence, in our subledger, which we'll take a look at shortly. So this would be saying that undeposited funds is going up. The other side going to sales is going up down here. We see then the sales tax payable. That's a liability that's going up. We see the cost of goods sold, an expense account, going up. And we see the inventory that is going down. If we look at the accounts impacted, the undeposited funds is going to be impacted for the year to date and the month because it's in the same way, because their balance sheet account inventory is going down for the same amounts for the February and year to date because it's a balance sheet account. Same with the sales tax payable is in this case going up for both the current month and the year to date. Here are our income statement accounts. Sales started for just the month. We had no sales yet. It went up with a credit of $2,200 to $2,200. For the year to date, we had $46,876 in sales. It went up by the $2,200 to the $49,776. And then we have the cost of goods sold started at 0. It went up by $1,760 to $1,760. On the year-to-date numbers, we were at $37,242. It goes up by $1,760 to $39,002. The impact on net income, here's the current month was a loss before this transaction of $346. It went up by the difference between the sales price and the cost of goods sold, which is $440, giving us an income on the month of $94. On the year-to-date, we had net income of $7,081. It goes up by $440 to $7,521. Undeposited funds was at 0, went up by $2,310 to $2,310. Sales tax payable was at $2,344, goes up by $110 to $2,454. Sales was at the $46,876. We're talking about the year-to-date numbers here, by the way. Goes up by the $2,200 to $49,776. Cost of goods sold was at the $37,242, goes up by $1,760 to $39,002, and inventory was at $9,698, goes down by the $1,760 to $7,938. This is the subledger for inventory, which is going to be tracking the units as well. So we sold, for example, an ELP in one of the items we sold above, and we had 5 of them. We sold 2 of them. We have 3 of them left at $400 cost. This is not the sales price, but the cost. And there's the $1,200. And then we sold this item down below, which was an EPSP. We had 6 of them. We sold 2 of them. We have 4 of them left. 4 of them times the cost of $480 is $1,090. $7,920. If we add up the ending unit costs for all the inventory items, it adds up to the $7,938, which ties out to the general ledger as well. So that's kind of us tracking where we're getting the information. A lot of that stuff would be done kind of behind the scenes within the QuickBooks software. So now we're going to say, let's then take a look at the next transaction, that same kind of thing for the second transaction, second sales receipt, undeposited funds going up. Well, let's start here. The sales is going up by $2,094, and then the sales tax is 5% of that, $105. That means we're going to receive $2,199. This would all be on the sales receipt, in essence, somewhere. This would not be on the sales receipt, but driven by the sales receipt. Cost of goods sold going up by the 1672, inventory by the 1672. So if we combine the two transactions we've done thus far, we've got a change in undeposited funds of $4,509, impacting both the current month and year to date in the same way. Inventory going down, total $3,432, impacting both the current month and the year to date in the same way. The sales tax payable going up by the $215, impacting both the current month and year to date in the same way because they are balance sheet accounts. The sales went up in total now for the current month was at 0, up by $4,294 to $4,294. And the sales for the year to date was at the $46,876, up by $4,294 to $51,170. Cost of goods sold was at 0. It went up in total $3,432 to $3,432. Year to date was $37,242, goes up by $3,432 to $30,674. Year to date before these two transactions had a loss of the $346, goes up by the net of the two, sales minus cost of goods sold for those two transactions, two sales receipts. And now it's at, that would be a net change of $862, goes to $516. Year to date was at $7,081, goes up by $862 to $7,943. If we look at the undeposited funds, we were at $2,310, goes up by $2,199 to $4,509. Sales tax payable was at $2,454, goes up by $105 to $2,559. Sales was at $49.76, goes up by $2,094 to $51,170. Cost of goods sold was at $39,002 after the last transaction, went up by $1,672 to $40,674. And inventory after the last transaction was at $7,938, goes down by $1,672 to $6,266. The impact on the inventory subledger, we sold some of these items over here. We sold this thing, which was an ERP. We sold 3 of them. We had 5 minus 3 takes us 2 left at $440. So we've got $880 worth of them left. And then we sold one of these, a GI USA. We had 5. We sold 1 of them. We got 4 times 304. We got $1,216. If we then pick out all the items that we sold in the subledger and then add up the totals that are left, we get to the $6,266. That should match what is on the inventory general ledger as well. Then we're going to say that we're going to take the undeposited funds and move them to the checking account, simply debiting the checking account and crediting undeposited funds. So here we have that, the checking account going up by the $4,509, same impact on both the year-to-date and February numbers due to it being a balance sheet account inventory. And then the other side on here is going to be in undeposited funds. This is including all the transactions that have happened thus far. So undeposited funds is back down to 0. The detail is down here in the general ledger. So we had the checking account was at the $98,344. It went up by the $4,509 to $102,852, and undeposited funds was at the $4,509, and it's going to go down by the $4,509.20. Note what we have over here on the detail is a deposit of $4,509, which we hope is going to match what is on the trial balance. So we're not just concerned with the ending balance, we're concerned with how the grouping will show up because we want to match our books to what is on the bank statement, making the reconciliation easier. And over here, in other words, you could have recorded these two transactions basically over here, making it a little bit more efficient for recording, getting to the same end result. But then you'll have 2 transactions over here, which we're imagining will not be how it's going to be showing up on the bank statement. That's the point of us using the undeposited funds as a clearing account to then group them in our checking account in the same format that we expect to see them on the bank statement. And then we can look at the detail of the transactions over here in undeposited funds, giving us these two detailed transactions, and then the decrease as it's removed from undeposited funds and going into the checking account.